We've had a bunch of red days in the stock market over the last week, and so today I wanted to share 5 things you can do to prepare for a market downturn. Good afternoon, family. Welcome back to the show. My name is Trey, getting in touch with you from Japan. On this channel, we talk a lot about finance, personal finance, investing, as well as entrepreneurship, mindset, growth, and things like that. If you haven't checked out our new series yet on how we turn $200 into $1 million, please click up here to check it out. In today's video, we're going to be taking a look at 5 things you can do to prepare for a market downturn / crash / face beating. So we've seen a bunch of weird news coming out recently. We've seen a bunch of stocks going down. Even like in Microsoft's case, they posted a really good earnings. They beat expectations and then they proceeded to go down. I think we might be overdue for a bit of a crash or a bit of a downturn coming up here soon. One of the indications of that is like we saw a couple days ago when Microsoft released their earnings and proceeded to drop. Here in Japan, I woke up to check the stock market close for Wednesday, and looks like Apple, Tesla, Microsoft, a bunch of other really big well-known stocks were all down 4 to 5%, and most of the stock market was down pretty similar numbers. We're also starting to see lots of scary news coming out. We see France just announced that they're going to lock down their country. A bunch of other European countries are discussing locking down again. England is posting 100,000 new cases per day. Even here in Japan, we're starting to see cases pick back up and in some cases exceed previous highs for daily pandemic infections. And so there could be potential lockdowns coming up once again. You know, over the last few months, people have been talking about, probably in the winter again, things are gonna get worse. Flu gets worse every year, colds get worse every year. Probably this sickness is gonna get worse too. At the same time, in Washington, we're also seeing news that the Democrats are blocking any kind of stimulus from going through. They don't want Trump to get any glory, and so they're making sure that doesn't go through. We might not see any kind of stimulus happen for it could be 2, 3, 4 months. And it sounds like in general, we should be expecting kind of darker times coming economically. All that to say, a few months ago after the second quarter finished, we had the worst economic conditions ever, and proceeded to post all-time highs in the stock market. So doesn't necessarily mean they're connected. And I would probably argue that the more disconnected those two factors become, the more we need to be aware of upcoming market uncertainty. So despite things like, Microsoft doing really well and beating expectations and then seeing their stock price go down, I think we need to take a step back and realize that there are some really big overarching, very macro sized things happening that we might not be able to escape even if you find the really trendy stock right now. And so I mentioned in a previous video also kind of the example of the Toyota Corolla. I use this example because it's like the car everybody has as their first car or everybody looks at as their first new car type thing. Let's just say it's $20,000. Everybody knows a Toyota Corolla in 2021 is $20,000. Let's just assume that. Now, different things happen in the world and all of a sudden Corollas are $40,000. It's one thing if only Corollas are $40,000, they've doubled in price. But it's another thing when every single car in the market has doubled in price. And everybody kind of knows the ingredients of a Toyota Corolla. It's like a compact 5-seater, 1.8 liter, 140 horsepower. You'll be able to drive it 200,000 miles and not really have any problems, and it'll be pretty comfortable and be able to do all the things you need to do for basic transportation. But for some reason, the value and the price have gotten out of whack. The value of the car should be $20,000, but now it's $40,000 for whatever factors. So the question for you now, let's say you were looking for a new car, is option A, you can say, that's weird. Why is it so expensive? Let's wait until prices settle down again. Or you could say, dude, I better run in and grab one because it's probably going up to 50 or 60K. Or you might go around and look at other cars and be like, dude, for the same 40K, I could get this really nice Lexus. And so when the price and the value of a stock in the same way get disconnected or get really wonky, it should trigger something in our brain to start, asking questions. One of the things we're seeing right now in the stock market, especially because there's so many exuberant beginners in the stock market, it's really, really easy to play with stocks now. A lot of people are getting stimulus income that they otherwise wouldn't really need. And so in an earlier video, I mentioned Yahoo Finance and a survey they did that showed basically that there's a really, really high number of young investors in the market right now, and a bunch of them are all in on stocks. They don't have any cash handy. And a bunch of them, like 40% of them, are even using options and derivatives and things like that, leveraging their potential gains. But what we're also seeing at the same time is kind of this weird trend where, going back to the Corolla example, $20,000 car, now it's $40,000. Like it'll go down to $38,000. And there's this huge realm of people in the internet who will be like, oh my gosh, it's only 38 grand now. It's on sale. Everybody buy, buy, buy. And that has been working for the last few months, and it'll like go back up to 40 or 41,000 kind of thing. And so one of the fears that we need to possibly consider is that the Corolla price, even though it's like, oh my gosh, it just went down 2 grand to 38,000, buy, 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 it might go back down to 35,000, might go back down to 30, 25, 20, 15. And so if you're spending all your money buying back in at 38,000, what do you do when it goes down? So in today's video, we're going to talk about 5 different things you can consider, or 5 things you can do to prepare for a potential market downturn. And the last one, number 5, is probably pretty new for a lot of you. It's something that I do frequently, and it's something that I've benefited from with very little risk too. But before we get into them, just so you know, I've been in the market for about 11 years. I'm not like a super elite advanced investor, but I've seen my fair share of ups and downs in market cycles, and I've done pretty well. I've done better than most people I know, I think, in the stock market. And so I've seen how you can really capitalize if you're in the right position, if you're in the right posture, when things really hit the fan, you know what I mean? And another thing for you to think about before we get into the 5 steps is to figure out your risk tolerance. If you consider investing or stock trading basically as like gambling, like I have $500 and I don't care about it, I'm just gonna try and turn it into as much as possible. That's a very different mindset than the person who's like 58 years old, who's like invested in very conservative companies their whole life, who's kind of like, I just need to, get to $800,000 before I retire in a few years. And then at that point, I'm going to clock out and be done. So these are 2 very, very different mindsets, and you need to be aware of your own risk tolerance. And you also need to be aware of your own goals and kind of time horizon. I share more about that in another video I made earlier, so check that out if you have a moment. Step number 1, consider what you would do. Just imagine what would happen if the stock market went down 30 or 40% tonight. So we're not necessarily assuming that will happen. If you look at the stock charts for March, we saw that things went down 30, 40% over a few days. It was like the fastest decline ever, I think. Let's just imagine, like yesterday things went down 5%, and over the next 5 days, things are gonna go down 5% every day. What kind of position would that leave you in? Would you be like, oh dope, everything's on sale now, I can go shopping? Or would you just be like, oh my gosh, I've lost so much, I'm so jacked, now I just have to wait maybe for a really long time and hope things go up? What position does that leave you in? Would you not be able to pay your rent? Would you not be able to pay your loans? Would you be in trouble? Or have you put yourself in a position to be like, yeah, that's okay. I'm okay with that loss for now. You don't necessarily have to sell things, things could come back and go even better in the future. But would the amount of cash you have on hand be enough to cover your costs and expenses in the coming weeks or months or quarters? So take a minute to consider that. And once you figure that out, we can look into the next steps and start taking action based on, am I in a safe position even if things went really bad in the coming days? Step number 2, pay down margin or deleverage yourself. Now, if you don't know what any of these things mean, don't worry about step number 2. But if you are using leverage, if you are margining yourself, it might be a good idea to back out of them. One of the things that happens when stocks go the wrong way of what you're predicting is that you can get margin called, you can get stopped out, and that can basically lock in huge losses for you. That can be really devastating, especially if you don't have things proportioned well in your portfolio. Strangely, like we saw in the second quarter, like economic news was getting worse and worse and worse. Unemployment was getting out of hand. Companies' earnings were like diarrhea, and people were basically like expecting things to suck, but then stock prices kept going up, 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 up. And I had a couple of small short positions, those kinds of short positions where it's like, yeah, if this works out, it's cool. But if it doesn't, I'm totally okay. I had a couple short positions expecting everything to go down. And so when it went back up, I was like, okay, I just got to take a loss. I'm not sure how much more it's going to go up, But if you were leveraging really hard in a situation like that and it went super up, that could take you out and kind of kneecap you for a very long time. So de-leveraging yourself in this time, I think, is a really good idea to lower your risk. Step number 3, keep cash on hand. This is one of those things that I tell you in almost every video. Please keep cash on hand. Keeping a portion of your portfolio in cash gives you a couple of really big advantages. Number one, when the entire stock market gets moon-kicked in the face, your cash doesn't change. And so that's kind of, that's like the one line item in your portfolio that's just like plus 0%, while everything else is like minus 10, minus 20%. The cash part of your portfolio is like, no problem, guys, Number two is that you can go on a shopping spree because everything's on sale right after things get kicked in the face. Everybody's been going shopping for $40,000 Corollas. Now all of a sudden you can get one for $20,000 or $15,000 or $10,000 and you're like, hey, this is a pretty dope deal. This is cool. Now, depending on your level of risk tolerance, some people say, yeah, 10% in cash is enough. I would argue if you had a $100 portfolio, $10 in cash isn't going to get you very far. But if you had a $100,000 portfolio or $1 million portfolio, having 10% in cash can get you quite a lot. But it's basically like a lever. The more risk averse you are, the more cash you want to be keeping on hand. So if you're like nearing retirement or you're saving up to be able to put a down payment on a house coming up soon, these kinds of people might want to have a higher cash position to lower your risk. For me personally, I'm the kind of guy that is expecting a downturn, and I'm also not afraid to just go crazy when I see a downturn. For a lot of my positions, I got out kind of like January, February, or I like dollar costed out. And then when things crashed in March, I went shopping, dude. I bought a lot of stocks. And for a lot of those positions, I've already taken gains on those, And so I'm the kind of guy, like, I have a lot of cash, not because I'm necessarily conservative, but because I want to go hunting when things are down on their knees. The Corolla example again, every Corolla on the market right now is like $40,000. It's like, wait, why am I paying that much for that stock? And so I think we could potentially see market conditions like this continue for a very long time. But if things do go on sale, I might be able to go out and go shopping and make some really quick gains on those. Tip number 4, consider taking profit on green positions. So I often mention that I like to dollar cost average into stocks over a very long period. And then I also like to dollar cost out of stocks over a long period. And one of the neat advantages that gives you is that you can basically choose how much profit you want to keep and when you want to keep it, kind of thing. Take a look at this chart right here. Right now, if you look at my portfolio, we have the Costco stock. I saw the daily price change went down more than 2% yesterday. But because I've been dollar costing in over a very long time, my total gains are still at more than 25%. And so I can go in there and be like, I think things might be going down more. It could be going down 2% every day over the next coming weeks, and then all of my gains would be lost. Or I could sell a handful of those stocks, lock in the 25 or 35 or 45% gain or whatever it is, and keep that cash and then buy back in when it's cheaper later after things go down a lot. Now that's a little bit more of like an active stock investor approach as opposed to people who are more hands-off or passive. And so that strategy might not work for everybody. But if you're pretty convinced that things are going to be looking bad going forward, it's not necessarily a bad idea to take some gains. I talk a lot about companies like, Apple, Tesla, Square, Datadogs, like Lemonade, these kinds of like potentially world-changing type companies. But Costco is another stock that I like because it's standing up to Amazon, has super high loyalty, pretty good margins, and it does well regardless of pandemic or e-commerce or whatever. And actually their e-commerce is growing too. Click up here if you haven't seen my video yet. But in this example with Costco, I know Costco will do well in the coming years. So I don't have that risk like I would have if I was just investing in some random small penny stock that people are talking about on Reddit, where it's like, dude, is this actually gonna go bankrupt? Dude, it's gone down 2% every day for the past week. I might lose 100% of my money. Like, I don't have to worry about that with Costco. And that's why I don't invest in those like pump and dump type stocks. And that's why I don't invest in just the trendy thing on the internet right now. And I encourage you, if you like to sleep at night, to consider this kind of strategy. And so I know like, oh dude, even if Costco goes down 20%, I still want to keep the stocks and I will be buying in more because Costco's the bomb, you know? And so that's one of the reasons it's really important to be figuring out the long-term vision of your companies that you're investing in. And again, like I mentioned in tip number 3, you know, if Costco goes down 10 or 20%, it probably won't. But if it did, I could just go in and buy more for cheaper, locking in that profit that I got earlier and then just throwing it back in to buy again at a cheaper price. Tip number 5, consider selling covered calls on your larger positions. Now this one's a little bit more advanced than all the other steps I've mentioned so far. You may or may not have heard of covered calls before, and I could do an entire series on how these work, but I'm gonna try and break it down like super simple for you. So when we're talking about options, there are like loads of different strategies you can use, and the most basic are calls and puts. Every option contract, one contract equals 100 stocks. So we're always talking in denominations of 100 shares. So an option is basically, let's say you have 100 Apple shares. I can say, hey, you, Steve, whatever your name is, I'm going to write a contract with you and I'm going to pay you for this contract where I have the right to buy Apple at X price that we agree on at some point in the future before expiration, whatever that we agree on. Same thing with puts is the opposite. I think a stock price is going to go down. So basically we're writing a contract that allows me the option to buy a stock at that lower price. Now a covered call is the opposite. So for me, I have more than 100 Tesla shares. So I can write a covered call. So let's say I have 100 shares of Tesla, which are $406 per share right now. And I'm saying to you, Steve, hey Steve, I'm selling you the opportunity to buy my 100 shares for $480 per share by the end of November. And you have to pay me a little contract fee for that. So the neat thing is, if it never goes up above 480 bucks, he's not gonna buy my stocks because he'll be losing money. But I get to keep that contract price that he paid me. Now, the scary thing is, if the stock price goes up to 800 bucks, he's gonna buy them at 480 bucks, and I lost out on, you know, that 320 buck difference. Like I ended up selling my Tesla shares for way less than they could have potentially been worth. And so that contract price, that's called premium, is very dependent on what kind of stock you're looking at, how volatile the price is, and things like that. For me, I recently sold a covered call contract where I said 480 bucks by the end of November, and he paid me like $1,000 for that. I keep that $1,000 no matter what. I'm pretty sure Tesla's not gonna go over 480 bucks in the next month, but if it does, he has to pay me 100 shares times $480. So I'm still locking in huge amounts of profit because that's like way more than I paid for those Tesla shares. But I'm basically betting that it's not gonna go up almost 25% in this time, you know? And then when the contract expires at the end of the month, like I get all my stocks back, we're free and clear, but I get to keep that $1,000 premium. Now that works with Tesla because Tesla's really volatile. You know, I also do it with Apple, but for a similar situation, I would maybe only get like 200 bucks for an Apple stock. If you're looking at penny stocks or stocks that are like 10 or 15 bucks, you might only get like 5 or 10 bucks for a similar scenario. So that's one of the things you can do with stock positions where you have like hundreds and hundreds of stocks. And that's generally, you know, like I'm kind of expecting things to go down. If they went up hardcore, I'm still gonna lock in a bunch of profit. But even when things are just kind of like, you know, there are a lot of years in the world market where things are just kind of flat for a very long time, you know? And if you have thousands or tens of thousands of a certain stock, you could just do like every month, just selling covered calls to pay my bills. And that's one of those things that really advanced traders will be doing to lower their cost basis. They'll take that, for example, with the Tesla example I gave you a minute ago, they'll take that $1,000 and just buy more Tesla stock. Or they could take that $1,000 and live off of it. Or they can take that $1,000 and just write that into the cost basis. So instead of, you know, my cost basis was this much for Tesla, I can subtract $1,000 from that now. And now my cost basis is a little bit lower. Things like that. So these are 5 different ideas for you, 5 different things you can consider with a potential market downturn going forward. Let me know in the comments section if you're already doing these things, if this advice was garbage, or if you want to learn more about any of these ideas. Let me know in the comments section. Let's have a discussion. I would like to know where you're at, what kind of positions you hold. I ran a poll on the channel the other day, and it seems like 70-80% of the people watching, people who replied to the poll, were like, we only care about super risky stocks that might double like tonight kind of thing. And there aren't a lot of people on the channel seemingly who care about, just kind of Costco, Visa type stocks who are just kind of solid and steady moving forward. So really interested to hear your thoughts on the video. Looking forward to talking more with you in the comments section below. Thank you guys very much for your time. Thanks for watching all the way to the end. It means a lot to us here. Love you guys. Have a great one.